placing any trade, all securities and orders are discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equate future results, and results discussed in this webinar are not typical and are only valid on the specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, now we can get going. What are we going to talk about today? Let's see. Well, oh, here's a question already. All right, wait, let me share my desktop first so we can see where we are. Share my desktop. Okay, hopefully this is working. I need my chat box so I can see what you guys are saying. Okay, and now let's put up something more interesting then. There you go. How about these? All right, Wayne. Wayne is asking, any comment on cliff rumors of possibly going to $1 or $0, lots of debt? Do you think they're in trouble? Yeah, of course they're in trouble. I mean, the iron ore prices where they are, everybody's in trouble in that business. It's a question of whether or not they can service a debt longer than the crisis continues. You call it a crisis, but the low iron ore prices continue. So you have to be rational about these things. So you have to look at it and say, well, let's take a look at Yahoo and see what it says basically. All right, so we go from CLF. All right, so they're at $1 billion in market cap. They've got, and we don't know for sure that this is right, by the way, but when you do, by the way, when you're looking at balance sheet, always look at quarterly, because obviously the most recent quarter is going to give you your best view. So they've got $244 million in cash. You don't count receivables, but what you do want to do is you want to see if receivables and payables line up, and they don't. They have a lot more payables than receivables. But they also have inventory, so you have to look at that and say, well, that's kind of money that will be coming in eventually, hopefully. Albeit at very low prices, unfortunately. But that's, you know, assumably that's priced in with the current price of iron ore. So they've got, you know, inventory, blah, 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 and they've got payables. They figure they'll be able to pay that off over time out of their thing. So what's the big deal? The big deal is their debt. $3 trillion in debt. And another $3 billion in debt, another $1 billion in long-term liabilities and other liabilities. So you got to figure $4 billion plus in debt against not much cash. Now, what do we want to know? We want to know, are they currently paying their debt? So question number one, are they making any money? Answer, oh, look, they do. They made money last year anyway. Are they making any money now? No, they're losing $6 billion a quarter, so that's bad. But then you see that when you see that, you got to say, well, what the hell is that? And obviously, since you can see the income through the taxes and you see this earnings, you can tell it's a write-off because the massive tax the tax credit comes with the earnings. So they've taken this in fact, it's right there, non-recurring also. So they've taken a non-recurring charge. If not for the non-recurring $7 billion charge, they actually would have made money. All right, so there you see this net income down here, but they would have actually made some money if they didn't take a $7 billion charge. So they don't really, and you'll see this on the cash flow, they're not cash negative. They made, here they were cash negative. They went through $100 billion in that year, and that's because they were building that mine that fell apart, the Pascagoula, which is one of their big write-offs. They spent a lot of money developing a mine that never went anywhere. That's what really screwed this company up. But realistically, last quarter, they only were down $115 million. So they're burning, in this case, $115 million in a quarter. But that also, because of the write-off and everything else, and obviously when you do a write-off like that, you've got a ton of legal expenses and accounting expenses, and it's like doing an audit. You have to do a lot of stuff to get it done. There are some cash payments that have to be made. You have to, you're wriggling out of contracts and stuff. So they probably did have to disperse a lot of cash to clean themselves up. On the bright side, they've got a $7 billion tax credit. That means they don't have to pay taxes for like 20 years. So they operate. So any money they do make going forward is tax free. And as you can see, the cash flow have this. They borrowed they didn't borrow. They paid back, like I said, they had to restructure loans. They paid back $200 million of debt. That's why they had negative cash flow. Had they not paid back $200 million, they wouldn't have negative cash flow. So going from the other 3 quarters, they are servicing their debt. Even at these incredibly shit iron ore prices, they're servicing their debt. So the people who are telling you that they're going to zero aren't doing a very good look at their books. What they're doing is just sort of projecting like, oh my God, they lost $5 billion last quarter, therefore they're going to zero. Well, sure. And if they were JCPenney, that would be true. If they were Radio Shack, that would be true. Because those are not things that are turning around. Those are not one-time problems. Those are problems like the entire business is messed up and it's not getting fixed and they're losing money with every sale. All right, so, and again, but now the point is they are in fact cash flow probably either neutral or a bit negative. Now, that being said, even if you're servicing your debt though, the problem is when you have $4 billion in debt and you're a $1 billion company, there might be loan covenants in place that force you to liquidate assets if you fall below certain ranges, and that's in either this. I mean, look, it's knowable, but it's not knowable in the course of like you and I are going to figure this out. They believe they've got $11 billion of what basically mining assets. So they think they've got $11 billion worth of stuff. Now, figure at a fire sale, that's $5 billion, right? Figure they sell everything for half price. But $5 billion is pretty good. Okay, so $5 billion means that they're basically about even. But if the value of those assets slips further, and their inventory, they say their inventory of $600 million gets written down because another 10%, another 20% lower iron ore prices, that's when they can start falling out of their covenants. Okay, and they can end up with a forced liquidation that would be extremely bad for them. So that can always happen when you're playing with companies like this. So you have to be aware of that. I mean, your $8 is at risk, or your net $5.25, whatever it is. But your $5.25 is at risk. But on the whole, I think this is a great stock, and I think they're going to recover. I think iron ore prices are going to come back. Now, I think that in the context that I don't believe that we're going to have an irreparable market crash. If we do have an irreparable market crash, if we go back into like a recession, then this stuff's not coming back for years. And you got to be prepared for that. And Cliff could go out of business. Anybody can go out of business. I mean, U.S. Steel almost went out of business in the last crash. Who the hell would have thought U.S. Steel was going to go out of business? Well, actually, I wouldn't say that. They had a couple of times they almost went out of business. But to really finally go out of business, they were almost there. The auto companies almost went out of business. The airlines almost went out of business. So you can't ever say it's going to not go to zero. You can always build a case for these guys going to zero. In fact, frankly, when Kokorian was buying GM, I told everybody GM was worthless. when Kikorian was buying it and shoving people into that stock before, before the big crash. And I was on TV and I was explaining to people, they lose, at the time GM was losing $20,000 per car they sold. And so my advice to GM at the time was, I was like, stop selling cars. If you stop selling cars, you'll save a fortune. It's selling cars that was killing them. They were actually literally losing $20,000 per car coming off the line. You can't run a company like that. It's pointless. Clips isn't a company like that. All right? But, so you have to look at a company and think about what it really does. But, again, you have no control over the price of the commodity that they sell. They sell iron ore pellets. Okay, we've talked about this in chat. They have contracts locked up for long term. It's just like oil companies with their hedges. They've got hedges going forward. They've got contracts going forward, but they're still tied to the spot price of Asian iron ore, and that is in a crash market, completely crash. It's not fair to CLF because they have a delivery advantage and a time advantage in getting the product to the people in North America where they sell most of their stuff, but it doesn't matter. That's the global price of iron ore is what they're tied to, and the global price of iron ore is in the dumper. It's like half of what it was last year. So, no, there's no way they can make money now, and if it doesn't come back in 2 or 3 years, they're going to be in serious trouble. And every month, every quarter, it doesn't come back for the next 2 years. They get closer and closer and closer to being foreclosed on. So what's the bet? When you have CLF, you're betting the economy turns around, the real economy, not the bullshit stock market economy, but the real economy where real people build stuff and have roads and trains and skyscrapers and things like that, where that part of the economy actually comes back and people start building things that require steel, that you're betting that's going to happen before Cliffs gets foreclosed on. But the same thing goes with the oil companies. The same thing goes with the gold miners, silver, everything. So all these people are tied together. All the material stocks are tied together. And we were just talking in chat. Where's my chat? We were just, right before I started this thingy, talking in chat about the market cycles. So here's your market cycles. Financials, technology, consumer discretionary. Wasn't all that stuff just going up, right? All right? Healthcare, staples, and utilities. Utilities actually were the star of this year. All right? So even though it wasn't really a bear market, but I mean, utilities went flying this year. Healthcare's been doing well too, but see, there's outside things on that. Healthcare's up because of Obamacare. Utilities are up because they pay dividends, and everyone's putting money into dividend-paying stocks. So that's why money's flowing into those guys. But generally, we're kind of in a fairly normal cycle with financials, technology, and consumer discretionary leading us higher. But there's a certain point at which all this money, in theory, all these tech companies doing so great, they start to actually build stuff and buy stuff. Like right now, Apple's building a gigantic corporate campus, and everyone does that. Facebook's got a place, there's a Googleplex about. All these companies, when they get their billions and billions of dollars, eventually they spend it on something. All right, Chrissy, please check to all participants in the chat. So eventually materials will come back, but the industrials will kick up, but the Dow will start. The Dow's still way behind the other indexes, that the Dow will start catching up and turning itself on. So we don't have that. We're not in an industrial rally. We're not in a materials rally. We're not in an energy rally, obviously. So either this whole thing is going to collapse because the whole rally is fake, or it's a real rally, and all of a sudden you're going to see all the materials and everything pick up again. All right, along with what I think will be inflation. I think things will start getting more expensive because all this money starts flowing out of the corporations. Right now, corporations are holding like $4 trillion worth of cash. $4 trillion is like almost a quarter of our entire GDP. All right, so our GDP is like $17 trillion, something like that. So it's basically 25% of our GDP. Even if it says it's 20% of our GDP, if they decide to deploy that cash over 3 years, they're going to add 5% to the GDP. Even if they deploy like half of it, they'll add almost 5% to the GDP for 3 years. We'll have a 10% GDP. And of course, if we have a 10% GDP, then then more people will have money, and there'll be more money spent on infrastructure and so on and so forth. And I do believe that to some extent that's going to start happening because, again, like I said, inflation is going to kick off because the Fed's just put $4 trillion. $4 trillion is an ungodly amount of cash, and it's just sitting in companies right now. It's sitting on the books of companies because they don't know what to do with it. They don't want to hire people because they don't trust the recovery. They don't want to spend money on infrastructure because they don't trust the recovery, and also because the government's not chipping in. That's the worst part, is the government, usually the government leads. The government says, okay, we're going to build highways and bridges and tunnels, and we're going to build new electrical systems and stuff. And now if the government says, we're going to make this investment, then a company says, okay, since you're building all that stuff, for sure, that we know it's going to happen, that nobody's going to suddenly cut the budget and change their mind. When we know these things are going to get built, then it makes sense for us as a company to build a new hospital and build a new terminal station and put up a new shopping mall. It starts making sense for people to build because the government's investing. The government's saying, I for sure am going to spend $100 billion in this town. And so these companies go, well, then we'll spend $20 billion also. If you're spending $100 billion, we're happy to kick in $20 billion because we want to take advantage of all the money the government's spending in this area. This is the broken part of our government now, because our government doesn't spend any money. There's no incentive for companies to spend any money. Instead, the government gives money to the company. That makes no sense at all. It's a completely broken system. It's got to change. Now, the problem is, unfortunately, if the Republicans get elected in 2016, it won't change, and then we're possibly heading for a massive economic collapse. So anyway, it's hopeful just over the next 2 years, though, that Obama will start spending some money, or they'll be able to somehow get something through and get some things done, because we have to, because, you know, we're just not doing enough to build up this country and to make any kind of lasting changes. Anyway, all right. Do you do a scan for companies to research, or do you pick at random? Chrissy is asking me. Chrissy, totally at random. I have a monkey, and he throws darts, and he's very, very good. And we have a dartboard full of symbols, and that's how we get stuff. No, I read. Actually, the way I pick stocks generally is I read the news, and when I read the news, that makes me start looking at stocks. I don't look at stocks at all. I look at the news, and when the news tells me something is happening, then I will go and figure out what stocks are going to make money from that event. So in other words, like oil prices get low, I say, well, oil prices are low and they're going to stay low for a while. Who makes money from low oil prices? Or I see, I don't know what's in news at the moment. Hang on, let me see, take a quick look. Well, you know, we have Russia, we have China, we shorted FXI. We looked at Japan, we shorted EWJ. You know, so when we see something happening, that makes a play. When I read that Monsanto had much better than expected earnings, or if they're having, or like we were talking about BTU, and my problem with BTU is I'm worried they're going to change the climate laws. If they do and they don't, that matters a lot as to whether or not we're going to make a heavy bet on the coal sector. All right, so I don't screen for stocks. I could care less what. I mean, once I decide on a sector I like, or once I decide on a story I like, then I look for stocks inside that sector. But I know that. I don't need the screen to tell me that. And then I look at each one and evaluate them very quickly, just like we just did with whoever the hell we were just looking at. I forgot, Cliff. Just like we did with CLF, I'm going to look at each company in the group and say who's the best looking company to pick in that sector. And I used to mention the casinos. Is that no longer an interest? No, it is not, because look, I mention things when they're low, and then when they get high, I lose interest. I'm not interested. We're not in a mode of shorting right now, so I'm not looking for things that are too expensive. And the casino plays ran their course. We made a huge amount of money off those, but now they're all high. So I mean, if we take a look at let's see, not this year, it was last year. We love Caesar because they were, again, it's just like CLF. In fact, they were supposed to go bankrupt. You had a ton of articles being written about how awful they were. Down here, $4. So when we had this seminar in Las Vegas, this is when it started. We started talking about Caesars, and I said, I love Caesars. And so we made a pick for Caesars for the next year to pay for our trip. And as you can see, it easily paid for our trip. It went up like 4 times. We did a play on Caesars to pay for the trip to go to the next seminar. And even this year when it got low again, I picked Caesars again and said, look, it's going to turn back around from here. And we're down $9 in October. We're almost doubled by November when we had the seminar. I like them when they're low. I don't like them when they're high. Why would I like them when they're high? So Caesars I like. Now I don't like them anymore if they're too confusing, though. Then we've got MGM. Oops. You got MGM, which is a film company and a casino. They also, see, they were cheap, and we loved all the casinos here, but we don't love them here. Why would I like them? When I used to buy them for 10, why would I like them when they were 20-something? Then Wynn is, I don't like Wynn at all now because I think they're silly pricing from the Macau stuff. We were shorting Wynn, in fact, actively. When Wynn was up here, we were shorting them. Now they're down here. And it's the opposite thing. We liked Wynn down here. We stopped liking them up around here. We hated them here enough to short them. Then they went down to here, and we were happy, and we took our money. And now they're here, and I could care less. They're sort of in between. If they got too high or too low, this goes back to that Levi thing, right? It's like I know what Wynn is worth, and Wynn is worth probably about 160. So at 150, I could care less. But when they're at 100, I love them because they're 60% too cheap. When they're at 200, I hate them because they're 40% too expensive. And that's the thing. It's not about, I don't need a scanner to tell me that. I know what Wynn is worth. I know what they're worth based on the current situation. And if the risk factors change or something changes, one of the things we saw coming in Macau was that they were going to crack down on the corruption that goes on in those casinos, and that's what happened. That story's washed out, though. So there's no special information that we have that makes them a good trade. And they're also, and again, they're not in the bottom of the range and they're not in the top of the range. They're in the middle of the range. That makes them incredibly uninteresting to play. I like to find things that are at the bottom of the range. But you know what's funny? When I find something at the bottom of a range that's ridiculously cheap, like CLF, when I find something down here, and now again, you go back, let's take a look at, not Wynn, but let's take a look at, where's Caesars? Okay, so when you look at Caesars, when Caesars was down here, it looked just like Cliff. And we had the same conversations. It was the same kind of things. I mean, like, people say they're going to go bankrupt, so we should stay away from them, and that's a bad stock, and blah, 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 and Caesars can't possibly survive. And, again, it goes back to the Levi thing. I'm like, there's a value to this thing. It's not zero. They're not bankrupt yet. They're going concern. They've got tremendous amounts of assets. They're in a unique position because they are the biggest by miles supplier of iron ore pellets in North America. And North America is their market. They're not in China. And they're not a coal company. And people keep classifying them like a coal company and beating them down for that reason, too. And they're not a coal company. The only coal mine they have services their own stuff. It's their own internal mine to give themselves coal. They don't give a crap if anyone else buys it. So they're oversold. At this price, Cliffs is oversold. Just like MGM was oversold, just like Caesars was oversold. But there's an actual price value. So for right now, in this current market condition, I think Cliffs is worth about 10. But that's in the current market condition, assuming that we're not going to get worse. If we get worse, then market conditions change and they're not worth 10 anymore. All right, now how do you determine a value for Wynn? The same way we just did it for Cliffs, and I'm not going to do it for every single stock. I mean, it's the same thing. You look at what they've got going, what their future premise is. Now, don't forget, when Wynn was going up, we liked them because they built a new hotel. They went up to whatever the hell it was. They went up ridiculously. I mean, when they were too low back here, I liked them because they see, the reason they were down was because they spent a lot of money building a new hotel in Macau. Then they start going up because everybody starts going to their new hotel in Macau. But then when they go up to a certain point, I think, well, wait a minute, this is silly because everyone goes to the new casino. the year it opens. Everybody makes it, in other words, this year, where are you going? You're going to the new casino in Vegas. You want to check out the new thing. You don't want to check out the old thing. You've been to the old thing. You want to go to the new hotel on your trip this year. So everyone goes to the new hotel and plays at the new hotel, and the new hotel does a ton of business. But then a year later, somebody else opens up a new hotel, and your hotel drops. So that was a simple play this year. That was our premise of saying, well, they're done. The story's over. So the value changes because the conditions change. And that's what you have to understand, too, that things have a dynamic value. You can't value something just based on some numbers on a spreadsheet. You have to value something based on the entire condition of the market that they're in. And then this goes back to something that I really can't stress often enough to you guys, is stop playing stocks you don't understand. For God's sakes, it's like, the reason you have money to invest is because at some point in your life you learned something. You worked at a company, you worked at a job, and you have an expertise in some sector. Even though you're a waitress, you're an expertise in restaurants, you understand the restaurant business. Use that. Work in sectors that you understand. And I'll tell you, when I started, my father was a systems analyst. So I knew a lot about computers and technology and so on and so forth. So back in the early 80s, I liked investing in I had Microsoft, I had Intel, I had a lot of tech companies that I liked as they were moving forward. I liked anything to do with the internet. When the internet started off, I was like, this is going to be a big thing. Buy internet stocks. It was an easy play. Now, in understanding that, I also understood, though I started getting more and more into understanding this, then it became important about the shipping and the retail. So I started, because I had to learn, all I could learn about tech companies, I ended up learning about retail companies. So I started learning about the supply chain. Then I started to have to learn about shipping. Then I had to start learning about trucking. Then I started learning about what the costs associated with a trucking company, which turns out to be a lot of energy costs. And I started getting interested in, the reason I got into the energy sector was because of the variable of fuel costs was a very big deal in figuring out whether or not the shipping companies were going to make any money or not. And then I realized what a total scam the energy sector was, and I started investigating that more. So over the years, I learned these things one by one, like each thing leads to the next thing. But, I didn't, so you guys see it, and you see me, like I'll talk about all kinds of different sectors and things. But when you talk about biotech, I'm always the first to say I don't know crap about biotech. It's like it's a black box to me. I don't understand these companies. I mean, I get the premise and all that. I get the gist of it. But as far as whether or not one drug is better than another drug, or whether or not this is a better moneymaker for these guys or not, who the hell knows? It's totally outside my field of expertise, so I don't invest in them. I don't give a crap what kind of scanner it comes up. I don't care who recommends it to me. I don't care anything about it. I have no interest in investing in things I don't understand. And that's Warren Buffett's one of his top things. Don't invest in anything you don't understand, ever. So if you don't know how to determine the value to win, don't invest in win. You have to understand how to determine the value of a company. You have to understand what the value of something is. And if you don't, then get out of that sector. Pick a sector that you understand and become the world's greatest expert in it, and from that you will find that you will start learning about another sector that's important, one that touches it. And then become an expert in that too, and then you'll have a deeper understanding of your main sector, plus you'll learn something new. And from that you'll learn something else. But you have to learn this stuff. You can't just sit there and go by whatever some jackass recommends on the internet. It means nothing. Because the situation changes, the dynamics change, and when you're reading articles on your companies, you have to understand what it means. So in other words, when I go to Cliffs and I go to Yahoo Finance, this is another thing, by the way, where I talk about you should never have more than like 20 stocks, because when I go to Cliffs in the morning, and every morning you should be doing this to every one of your stocks, I want to see what my news is. So my job every morning is to read all the articles, at least on Yahoo Finance, that pertain to my stock. Now, it's slow, so there's only two, but here's Cliff rises on Chinese iron ore futures, which went up a little bit, but that's a one-day thing is silly, but that's just the way the stocks trade. And there's some mention of Cliffs in this article, but it's not important. But you need to be able to read these things and understand them. It doesn't do you any good to read them if you don't understand them. So in other words, if I go to if I go to ABV and I'm reading this and I see that so none of these are specific to them apparently. Evercore, hepatitis. Oh, here. Okay. So, here. Big value trap to Gilead investors. What the hell? Oh, man. So there's talking about Express Scripts and with the AbbVie deal and the Gilead and what happened. We talked about all this in chat like a couple of weeks ago. But you have to understand this stuff. There's a lot of dynamics at work here. It's a lot of complicated moving parts, and it has very big long-term implications. All right. In fact, here it goes. The prospect of weak pricing makes Gilead appear to be a less attractive investment. As a result, Merrill Lynch downgraded them to underperform, lowered their price target to 87 from 130. That's a vicious downgrade, $40. That's like 1/3 of the value. And they put a sell rating on other firms, and now they've lowered their PE estimates and blah, blah, blah. So when you look at that, you've got to understand what that really means. Not just like, it can't just be words that go blah, blah. It's not a Charlie Brown teaching moment. You've got to understand that it's talking about Guild. You've got to understand what's going on here. And we talked about this because when they dropped from 116 to 85, or now to 90 over this mess, and it's getting right now with a technical bounce, but that doesn't mean it's going to come back from that technical bounce because the situation has changed. They're not going to be able to just charge whatever the hell they want for this drug anymore. And again, I'm saying this in the context of, like, I don't play biotech because I don't really know enough about it. But this I understand because this is marketing, sales, and manufacturing and distribution. I understand that. And what I understand from this is that their key drugs, and this is only one drug, the first domino to fall, is that these key expensive drugs that they spend billions and billions of dollars developing, they're not going to be able to just recoup their money by charging $10,000 per pill. Because the drug companies are putting their foot down saying, we're not paying $10,000 per pill. Now, to some extent, these are the death panels they warned you about, isn't it? Okay, the death panels aren't government death panels. The death panels are your insurance provider now telling you, I'm sorry, but it's not worth keeping you alive on these pills. And at this stage right now, they're going to Gilead and saying, hey, we're not buying those pills for that price. We've got to deal with your competitor by it's not as good of a pill, but it keeps people basically alive about the same. So, it has more side effects or whatever the hell the other problems are. Bottom line is it's cheaper, though. That's what matters. Now, that's going to take years for the industry to adjust because they're going to have to start saying, well, you know what, maybe we don't shoot for, like, the lesser side effects. You can't come out with a pill that's an improvement on somebody else's pill just because it loses one side effect if it costs more. It has to cost less and not have a side effect and be beneficial. Now, that's actually kind of good for the consumer over the long run, but over the short run, it messes up a lot of people's plans, and a lot of people have things in their pipeline that just aren't going to be as profitable as they thought they're going to be. So this whole sector is going to be a total mess for about a year or two. A lot of revaluation. And a lot of it's going to be nonsense. Like, I think probably that downgrade by Merrill Lynch is probably overdone. I think Gilead's got plenty. I think they can adjust and so on and so forth. And you see they're floating right around the 200-day moving average here, right there. But you can see the 200-day moving average. So this is really just sending them back like a normal correction. This year they had a correction. They had a correction here in 2013 and 2014, and now they're going to have one in 2015 to come back to the 200-day moving average. I don't think it's really going to be much worse than where it is now. But the point is, though, I also don't think it's going to go springing back up. All right, so that goes to anybody. But but the point being that when you talk about Wynn or whoever, you can't. You've got to understand what something's worth. And it's like I said, how do I determine the value of a pair of Levi's? I determine the value of a pair of Levi's in part not by going to the Levi factory and finding out how much cotton costs and blah blah blah. I don't do that. I know the value of a pair of Levi's because I'm a user of Levi's, because I've been buying them my entire life, because I've tried other jeans. I understand the category of jeans, and I know that I don't want to pay the extra $50 for a pair of Guess jeans. They don't do me any better. I don't feel better in them. They don't seem, it doesn't have an advantage to me. And I don't like Lee's as much because they don't fit me as well. And I know what the usual price of Levi's jeans are. They're usually about $40 when they're on sale. I know they retail for $50. They usually you can get them for $40 if you're patient, or if you look around, they're $40. And that means if I see them for $40 and I need them, I'll buy them. But if I don't need them, I'm not going to buy them. Which same thing for stock, though, right? You don't need a stock, so why would you buy it if it's not on sale? This is one thing people don't understand about stocks. It's like if they're not on sale, don't buy the stock. Why would you ever buy anything that's not on sale? That goes for life too. I find that in the supermarket too. It's very funny though. I always notice that. But you know, you go shopping. I do have brand preferences, but honestly, 90% of the things, it's like I'll usually just pick up the thing that's on sale because it's such a huge difference. You know, if I'm looking at things, I see one thing says it's on sale, and the other thing, like ice cream is a good example. Like in the fairway by my house has an aisle of ice cream on two sides, both sides of a refrigerated aisle, and you walk for like 150, 200 feet, and it's all ice cream on both sides. They have every conceivable ice cream known to man, and some are on sale and some are not. And I never, ever would buy one that's not on sale. In fact, my kids know that. My kids are like, well, my kids go down the aisle and they're like, oh, this one's on sale. Because they know I refuse to buy one that's not on sale. Because, like, you know, they take $2 off a $5 ice cream. And it's not like I can't afford it, but it's just a matter of principle. It's like if one's $3 and one's $5, why would I buy the $5 one? Well, that goes to stocks too, doesn't it? Yeah, so Tesla's overvalued. But I don't care. I say it's not overvalued enough for me to care. Yeah, okay, you're not getting the point. Is that okay? Let's take a look at. All right, how do you look at Tesla? Tesla's a ridiculous one, but we'll take a look at it just for kicks. Where is Yahoo? How come I lost Yahoo Finance? Oh, I see. We have that article up. So on Yahoo Finance, first of all, you have an income statement, you have a balance sheet, you have cash flow. Those are the things. Those are your financials you want to look at. But you know what else you have? First of all, you have here's their PE. Now they don't have a PE because they don't make any money and they cost too much. You look at the market cap, $29 billion. You compare it for one thing. You know, you just got to play with this stuff. I can't take weeks to teach you all this stuff. It was really a matter of learning how to value stuff. But you look at their competitors. Here you go. This is a very simple comparison, right? Right there, competitors. Market cap, Tesla, GM. So GM is double the market cap of Tesla. GM has 40 times more employees. They've got what is that number? 70 times more revenues. No, not 7. Let's call that 3. So let's say 50 times more revenues. They've got not as good a margin. Tesla has better margin. That's important. They've got a 3 times better margin. So give that one to Tesla earnings. Okay, earnings. I'm sorry, it's too funny. Tesla earns. What is that? 1%? Is that yes? Tesla earns 1% of what GM earns. Oh, that's too funny. Tesla earns 1% of what GM earns, but they are worth half of what GM is worth, or they are not worth. They are priced at half. All right, operating margin. Tesla has negative operating margin. GM has a positive operating margin. Positive, better than negative. Net income minus 200 million. Net income plus 2.6 billion. So again, it's 100 times better. EPS is obviously positive, net, positive, better than net. All right, so on every basic metric, GM is obviously better than Tesla. Then you look at some other competitors. Here's automakers ranked by sales. Tesla's not an automaker ranked by sales, but it gives you an idea. Look at the P, 22, 12, 10, 10, 10, $13,500. All right, that's the easiest way to value something. I don't need to look at the income statement or the balance sheet to understand that Tesla is grossly overvalued, insanely so. All right, then you look at the income. Well, it's a joke because there is no income. It's losing money. Okay, sales though on the bright spot, big bump in sales. So you have to respect the bump in sales like that. Now, has it kept up though? Are they doing better than $2 billion? Yes, they are. See, they did $2 billion last year, and this year it looks like they're, let's call it 8. Let's say they average 8. So that's going to be $3.2 billion this year. But unfortunately, still losing money. So they're selling more cars. This is like my GM problem, right? Back in the GM days, they're selling more cars, but they're losing more money. Last year they lost $74 million. This year, they lost $74 million in 1 quarter. They're going to lose 3-4 times more money this year than last year. All right, so they're selling. What we say, 3.2. They're selling 50% more cars, but they're losing 200% more money. This is not good. It's not overvalued based on, I don't think based on their competitors. They're overvalued compared to themselves. They're not worth what they were worth last year, yet they're selling for more, yet the stock is rocketing higher. That doesn't make any sense, so I wouldn't buy them. But from experience, and again, because we got interrupted on a Levi thing, from experience, I also know I shouldn't short them though, because I've seen them be priced. And people love buying them when they're under around $200 for a long time. For the whole year, people have been snapping them up at $200. They can't get below that line. They're not worth $200. They're not worth $100. They're probably barely worth $50. I'm not sure. I mean, if you ask me, would I pay $50 for this company? Would I pay $6 billion, $7 billion for this company? No. Why would I pay $7 billion for a company with $3 billion in sales that's losing $400 million? What is their real strategy? Not only that, though, but their losses are buried because they did a $2 billion raise for their Gigafactory, and they've been funneling money and making all these side deals and doing all this weird stuff, so they're cooking their books all over the place. The reality is probably a lot worse than what it shows. So I wouldn't touch these guys with a 10-foot pole as a bullish investment. I love to short them, but again, we're in the middle of a range. Okay, we're in the middle of the range on this stock is basically probably here. You look across here. So figure 150 is a real floor. It's probably a very hard floor for them, as far as it'd be very hard for them to get below that price, even though they're not worth it. Okay. But 150 and then up as high as 300. That's the range. So they're basically dead set in the middle of the range at 225. So why would I play it? It's not expensive. It's not cheap. It's like when I see $40 Levi's. I don't need them, and they're $40. If the Levi's are $30, I'll buy them because I know that's a good price, and I know I'm probably not going to see 25. The problem with you guys when you're buying stocks is when it goes from 40 to 30. You think it's going to go to 10. Because you don't understand the value. And the reason you don't understand the value is because you don't know the stock well enough. And you shouldn't be playing a stock you don't know well enough. You've got to know what something is worth, because not only does it tell you what to buy, but it tells you what to sell. So in other words, if I buy a pair of Levi's for $30, I know I got a pair of Levi's that I want to use. I have my brand new pair of Levi's. But if I go a week later and it's at $50, I knew it was 30. When I buy it for 30, I know it should be 40. If it goes to 25, that doesn't make me think they're not worth anything. I still want my pair of Levi's, and I think 30 was a good price. I regret I didn't get it for 25, but 30 is fine. Because I have use for them. That's, again, the problem. When you buy stocks that you are actually planning on holding for the rest of your life, you have a use for it. When you buy a stock and everything is a trade and you're betting, you're not buying a stock, you're just making bets. And if all you're doing is making bets and you're not going to get any value out of your stock, and what's value out of your stock? Selling calls collecting dividends. That's value out of your stock. That's generating income off your stock. We just had that this week. Was it this weekend? I don't even remember anymore because of the holidays. Anyway, I just wrote a post about that, about long-term investing and creating dividend for yourself. That's what stocks are about. It's what that whole planting trees philosophy is about. You've got to grow your orchard, and then you've got to have that orchard bear fruit. You've got to buy stocks that are going to give you long-term value. What's the long-term value of Tesla? There's none. They don't pay a dividend, and they're too scary to sell calls against. Well, certainly puts anyway. If you own it, you can sell a call. But they're too scary because the amount of money you collect for selling a call doesn't cover the risk of owning the stock. So it's useless. It's a useless stock. It's not an investment at all. It's a trading vehicle. So you shouldn't even be asking me about this. You shouldn't be playing it. You shouldn't be going anywhere near it. It's a useless thing that's a waste of your time to stare at. Spend your time on things that are worth doing. This is the other thing. You know, if I own an ice cream shop and I sell ice cream for a living, how do I make my money? I make my money because I buy milk and I buy sugar and I buy cream and I buy ingredients and I turn them into ice cream. So I should always be on the lookout for cheaper bowls and cheaper spoons and cheaper fudge and cheaper ice and cheaper sugar and better machines that make my ice cream, right? But what if I see a fantastic sign making machine? Okay, that's not my business. You could say, oh, well, you might want to put a sign in your shop. I'm like, well, yeah, but I could go get that. I don't need to buy a machine that makes signs just so I can have a sign in my shop. I'm not in the sign-making business. It doesn't help my business to buy that machine. It's a distraction to buy that machine. I need an ice cream making machine, not a sign making machine. I don't care if it's the greatest sign making machine in the world. It doesn't matter. It's not what I do. And you have to understand that too when you're an investor. You need to buy stocks that fit your investing outlook. You can't buy stocks that don't do what you need them to do. So if you want to be a value investor, if you want to be a long-term investor, if you want to generate an income when you retire off your stocks, then you have to pick stocks that are going to be there when you retire, number one, that are going to exist when you retire. And Tesla is debatable whether it will still exist. Who knows if electric cars are going to exist in 20 years? Maybe they'll have something else. Maybe they'll have hydrogen. Maybe Tesla itself won't exist because just like a million other car companies that came and went, they won't sell enough cars. They won't gain enough traction. 50,000 cars a year is not traction. They sold 1 million Edsels. They're gone. You know, a DeLorean sold much more than Tesla did. They're gone. All right, so I mean, you have to, you know, it's just because it's trendy now doesn't mean that it's going to stay around. And also, they're not a dividend-paying stock. You're buying they're growth stock. Growth stocks are fine to some extent, but you have to have a plan for what you're going to do out of it. This stock has proven itself ridiculously volatile and is incapable of generating an income. So, you know, unless you really through thick and thin intend to hold this thing. If it goes, you have to say, I want to buy them 200, and then if they go to 100, I want to double down. If they go to 50, I want to double down again. And then you could argue and say, well, you know, if I end up owning four times at 50, and my average will be somewhere around 75, that's okay because then I can ride that out for 20 years and sell calls against it and so on and so forth and generate some income. That's fine if you really feel that way, but I'd still wait for a better sell-off on the stock. But on the other hand, there's 1,000 other stocks you can go out and buy, like Ford, for example, which we used on the Weekend Post, like Ford that can generate an income right now and make huge amounts of money. So why mess around with this idiotic thing? But it comes back down to what do you know? What do you understand about the markets and how are you going to make money? Make money from what you know. Don't make money from what you don't know. Don't make money from what other people tell you they know. Because how can you sit there and watch it? How will you understand the daily movements? How will you learn anything? And think about that too. You're putting your money in I say this to people because they lose money on a stock or whatever. So, you know, trade goes bad. And they understand. And if they say to me, like, okay, this trade went bad and I did this and this wrong, I say to them, I say, look, at least you learned something. You might have lost $10,000, but you learned something. It's like going to college, right? You spend $10,000. I mean, you spend a lot more than that. You spend $40,000 a year. It's $20,000 a semester. So if you think about it, if you lose $20,000 in the market, that's just like going to school. But you better learn something from it. Okay, and what you learn can't be, oh, I'm not listening to that guy again. That's not learning anything. Learning means that you took the time to understand the sector and get to know a stock better, that you bought this stock because you're tracking its performance, you're learning more about the company, you're taking a heavy interest in it, and when you get out of it, win, lose, or draw, you're going to have a deeper understanding of how that stock works. So even if you never play it again, at least you understand why you don't play it again. All right? That's really important. And it's not going to, you can't just pick 10 things at once. You've got to look through your portfolio and say, do I really understand these companies? If you can't explain to your, like my kids, I can explain any of my stocks to my kids and tell them how they make money and what they do. In fact, I do. When I've invested, annoys the crap out of them. When we go places and I happen to have a reason to talk about a stock, I'm always like, yeah, it's like we have mark-out papers in my house. I explain them how mark-out paper works and how the company works and where they are and what they do and so on and so forth. Sealed Air is down the road from me. Pfizer's down the road from me. So, we talk about that, and we talk about, do they look like they're doing good? When we're in the mall, I talk to them about, like, hey, here, this store is doing good, this one's doing good. Do you realize the whole mall is owned by a company? Which one is on mall? Westlake? Anyway, so there's a REIT that owns the mall, and I explain to them how the REIT works and how they rent out the stores and what happens and what they have to do and what their costs are. All this stuff is important. And I'm teaching this to my kids the way my grandfather taught me this sort of stuff. He used to tell my grandfather, tell me all these things when I was a kid too. And eventually they'll get to understand some of it, and they'll internalize some of it, and they'll understand when they go to become investors, they'll understand what to invest in. But you got to do that for yourself also. And if you've got 20 stocks, and when you spend all day trading in and out of 20 stocks, or you're day trading everything, whatever, you're not learning anything. What you should be doing is researching and reading and studying and getting to learn a sector. And if you own a stock in one sector, you should be reading up on all the competitors and understanding why all the competitors are moving and what they're doing and what's causing the stocks to move and what's causing the sector to move. And if something's moving in that sector, you want to understand what that is too. And if you do that, you're going to learn something that is valuable. And the more valuable things you learn, you will eventually be able to put them together and have a valuable portfolio based on your knowledge of the market that's unique. And having unique knowledge gives you an advantage. Following tons of other people doesn't give you an advantage, but understanding something other people don't understand gives you a tremendous advantage. It lets you, and it also helps you to pull the trigger when something is cheap. All right, so we went back to that thing about need. I don't need Levi's. I've got 4 pairs of Levi's. I don't need them. So even if I saw one for $30 on sale, I wouldn't buy them because I don't need one. On the other hand, though, if I saw one for $20, I'd buy it. Because I'm like, well, you can never have too many jeans. And if I saw that they went up to $50, I would probably consider selling one of the ones I do have if you could sell them. But I'd say, well, that's too much. But you've got to have a value in your head of what your stock is worth, and you've got to know when you're going to get in and get out. So, the problems that exist are that you guys tend to look at stocks as they get cheap, and you think they're going to infinitely get cheaper. And then when you own a stock and it goes up, you think it's going to infinitely go up. And neither one of those things is true. And the reason that you have that tendency, though, is when you don't understand the actual value of your stock. Like when Apple went to 120, we sold it. We got out of our positions because 120 was a lot. I thought that was really obvious. It amazed me I had to explain this to people since we've been buying it for $80 a year ago. And I'm like, you know what? 50% a year is a lot. Let's see if we got that on the show. Yeah, here you go. Last year, Apple was our stock of the year. It was $80. It gets up to 120, and I told everyone to take the money, get out of the positions. We killed everything. This is not a complicated concept, is it? I loved it when it was 80. I didn't like it when it was 120 because 120 is too much. And I don't mean, and by the way, too much doesn't mean it's always too much. It's forever too much. It means at that particular moment, within 12 months, a 50% gain was more than I expected. Now we're back in it because we were in the 91-20 spreads. Here's our spread. In 2017, we think Apple is going to be at 120. 2 years, that's this entire distance here. So in this entire distance here, going forward about this far, we think Apple will be this much higher. that's our bet. And we have the 91-20 bull call spread for 2017. If Apple goes lower, we already have a plan. If Apple goes lower and tests the 200-day moving average, we're going to sell puts because we don't think it's going to go much lower than 100. We'll be thrilled if it goes to 90, and if it goes to 80, I'll probably want to double down because that's just incredibly low. Because I certainly think they proved that they're worth more than 80 over the course of this year. So if for some idiotic reason they drop down to 80 again, I think that's an incredible bargain. I want to load up the truck on Apple. But our bet is simple. Our bet is saying we took a $15 spread. It's $15 today, in fact. The 90-120 bull call spread. And all we're saying is that by the end of by January of 2017, around this far out, we think Apple will be higher than this spot. That's all. It's not a complicated bet. And if it is, we make 100%. There's my Levi's. All I'm doing, I'm saying I think Levi's are going to be worth more than $30 in 2013. In 2017, I mean. It's not a complicated premise. And if it goes much cheaper, I'll want to buy more. If it gets too expensive in the meanwhile, if it goes up to 130, if it goes up to 140, 160 in short term, I'll probably want to take the money off the table, just like we did earlier this year, because it's too fast. Obviously, I think Apple will be higher. I think Apple will probably be about 140, 160 in 2017, but I don't think it's going to go up 20% a year, 30% a year. It's at this point you have the law of large numbers. Apple is a $600 billion company, something crazy like that. Where are we? $650 billion. Okay, so Apple's a $650 billion company. So for Apple to get to 130, it's more than 10%. It has to gain $65 billion in value. Now, here's value. Let's talk about that. How would Apple gain $650 billion in? How would Apple gain $65 billion in value? Well, their PE is 17. So what does that mean? That means Apple has to make $3 billion more dollars. Right? Or let's say $4 billion more dollars, really. So Apple has to make $4 billion more dollars to be worth 10% more. See, this isn't complicated. How much do they make now? Well, they make $40 billion. Well, that makes sense, obviously, because if they make 10% more, they'll be worth 10% more. So you could have looked at it that way, too. But here's the thing. Apple's revenues, I mean, their earnings aren't really growing that much. 40 billion, 40 billion, 40 billion-ish. They're not making much more money. They're not selling much more stuff. Their earnings growth is not huge right now. I mean, it's a stunning amount of money, $40 billion, but it's kind of hard to make another $4 billion because where are you going to take it from? Where's the $4 billion going to come from? How does Apple make $40 billion? Well, they have to sell $182 billion worth of stuff to make $40 billion. So that means that it's like 4.5 times earnings is sales. So what did we say? We said that they have to make $4 billion more dollars. So to make $4 billion, well, obviously, so to make $4 billion more dollars, they have to sell $18 billion more stuff. Yes, interest on the cash pile, that's true. Yeah, they are making some money on just the money they have sitting in cash. And by the way, that's why Apple is still a bargain, because they've still got $200 billion in cash. So they're worth so much more than they are now, in any case, value-wise anyway. But anyway, so the bottom line is Apple has to sell $18 billion worth of more stuff. That's a lot. And there may be some growth in iPhone revenue. There may be some growth in iPad revenue, though that is actually not looking like there is. And that's when you start getting to what's really happening. iPad revenue is kind of flat. Laptop sales pretty much flat. Computer sales so-so. So it's really all about iPhone growth and whether they have anything new coming on the market. iPay, but it's really not that much. The iPay, if it drops $2 billion to the bottom line, that would be huge. It probably won't. I mean, the number of credit card transactions, since they get a very, very small fee, it's just there's an incredible amount of credit card transactions they have to do to get $1 billion. So they'll make money, but not phenomenal amounts. I think down the road they'll leverage it and they'll cut out the middleman, they'll cut out the credit card companies down the road, and then they'll make some serious money, but that's many years away, and they're certainly not going to do it until they've got tremendous market leverage. So, and by the way, we thought they were going to do that with the recording industry. They never did that. They never cut out the recording industry. So they may never do it. They may just be happy to go the way they are. Where was I? Oh, yeah. So until you see clearly where this $18 billion in new sales is going to come from, then I've got no reason to think Apple should be appreciably higher than 120. So in the earnings report, that's what we're going to look for. Are they going to earn 18? Are they going to make 18 billion more in sales? And by the way, even if they make 18 billion more in sales, see here they're 156, now they're 182. That's 26 billion more, right? They didn't make any more money. This wasn't profitable sales. It's just to keep themselves afloat, basically, on that price. So you have to look at it from that way. It's got to be 18 billion in profitable sales have to be made, added to what they're doing now. So the sales growth has to be there, and the earnings growth has to be there, and the margin has to be there, and you have to look at their product mix and look at the cycle and so on and so forth, and you have to understand it, and that's how you decide what Apple's worth. And that's why, even though it's our trade of the year, it's a very conservative trade of the year because we only need Apple to go up a couple of percent, and we're going to make our money. But that's why I like it. I like it because I think Apple is well worth 120 easily. And 2 years from now, I have no reason to think they're not going to be up well over 120. But I only need it to be 120. I don't need them to do anything spectacular. I just need them to perform decently for the next 2 years. And we're going to make a ton of money. That's why I like the trade. It's not the trade of the year because I think it's going to go up the most. It's a trade of the year because I think it's the most likely to pay us. That's what makes it exciting. The ability that we have to commit a substantial amount of our portfolio to a position where we have a very high expectation of making our returns. And Apple was the star of our portfolio this year. It was our trade of the year this year. It made us a ton of money. It made us like $50,000 in our portfolio this year. Almost half of the total was made by Apple, by that one trade. And next year, hopefully, it'll be another $50,000 on this Apple trade. Because it's the one we're the most sure of. All right, and then we did that BHI trade. That was like an arbitrage play. Let's see if we can see. Oh, yeah, here we go. Let's take a look at some of the portfolio, see how they're doing. Whoop, short-term portfolio is down. Why is that? The market is down. That's weird. Maybe we're not bearish enough, but I kind of doubt that. Oil's killing us. We have big play in oil. That's hurting. So anyway, so down to 60. We're down to a 60% profit for the year. It's hardly something to complain about. But so what do we have? We have January DXDs. These are looking terrible. They're 25 cents, but we're going to keep them over the weekend, to just over the New Year's to see what happens. And by the way, we're keeping them because they're down to a quarter. We only spent $4,000 on them in the first place. They're down to $1,000. So we lost $3. All we can do is lose another $1,000. It's not worth, getting rid of or changing right now. We already have April. We have July. Well, I'm sorry, that's not a hedge. We have the April TZAs. We've got these EWJs and FXIs are no good. Those probably should be killed because they're not likely to come in. But again, we'll do this on Monday. I think we'll probably change these. GMCR is a dead trade. That's unfortunate. Fast is well, that one's good. This Tesla is going to be fine. Oh, that's crazy. So even at 221, the Tesla January 140 puts is still $9. That's a lot. Imagine that. That's how scared people are of Tesla falling. That they'll pay you $9 to sell the next year 140 puts. So it's $80 away. The stock has to fall 40% practically for you to lose money on that thing, and that's what people are paying. That's how scared people are of Tesla falling. Here's Yahoo. This is just an old put. There was no point in selling it. KBH. Sorry, my eyes ago. So KBH, that's not working out, unfortunately. I think by April, though, it should. SQQ is another hedge. We took half of this off the table, thank goodness, and now we're left with this. Now, this is kind of ridiculous, though, because the June 30s, right, they're at 29, yet this spread, according to this thing, it's not correct, but this spread is worth 70 cents. All right, obviously that's not true, but that's, it doesn't matter. We just, we only go, we don't worry about the fact that these are inaccurate. We just worry about, like, do we like to trade or do we not like to trade? XRT has not been going well. These we should be buying back, really, the 91 puts. I don't have that price, though, but at 96, I certainly want to buy those guys back. Here's the rest of the fast trade. That's right now killing us. See, that's costing us $25,000, that fast trade. But, it's not important because it's in transition. This is a 2017 set of positions. So I don't care right now that it's costing us $25,000. Over time, it'll work itself out. We'll roll it and we'll deal with it. And here's Silver Wheaton, and that's fine. We like that. So nothing to change on the short-term portfolio. The long-term portfolio, hopefully, is doing well if this guy's doing badly today. And badly, it's down like 3%. Yeah, 20.7. All right. So the long-term portfolio, we have this big USO position that's down a lot. It's down $7,000. That one's hurting because oil is still going down. 53.87 at the moment. Then we got all these short puts. None of these are in particularly bad shape. Nothing to worry about it. Apple, here's an Apple spread. This is our main spread, 91.20 spread. We have 20 of them. So 20 of these guys is worth $60,000. We paid 25,000. No, what am I talking about? We paid 30,000 bucks. So we make 100%. We make 30,000 bucks if this works out. Currently, here's the funny thing: that currently it's showing the 30,000 bucks, right? So it's still showing 30,000 bucks, even though this trade is mostly in the money. It still shows it like that. Look at these trades. None of them are in really bad shape. RIG is the worst one, but we only have 20 short there of the puts, so I'm not even worried about that. You look at 2017, 27 puts. RIG's at 18. We're going to obviously adjust it at some point, but we don't need to adjust it until 2018's come out or something. There's no reason to do anything about this. So for now, it's down. But so what? We're not going to worry about that. Here's Apple. This is net obviously positive, and this is another Apple spread. And again, this is a weird thing about these spreads because you have to realize this is an 8,100 spread. It's totally in the money. We paid 20,000 bucks for it. It's currently showing a value of $28,000, but the full value of the spread is $40,000. So there's 12,000 more value to this spread if Apple stays at 100. So if nothing happens, we make 12,000 bucks. None of this stuff is ever reflected in your portfolio. You have to understand how the math works on these things. Same thing for these 80 puts. Currently, we're being charged negative 12,000 bucks for the $80 puts, even though Apple's $35 above it. All Apple has to do is stay over 80, 12,000 bucks drops in the portfolio. So we got $12,000 here, $12,000 here, it's $24,000. We have $30,000 here. That's 44. Did I think is that right? 44,000. Wait, 12 and 12 is 24, and 30, $54,000. So if Apple just stays, if Apple hits our 120 target, we have $54,000 coming to us. You got to know that. You have to understand how your portfolio works. So we have $54,000 upside based on Apple doing well. That's why in the short-term portfolio, we have a very large SQQ hedge, because the SQQ hedge protects us from Apple, which is a huge part of the NASDAQ, going down. We have a very large offset, and the reason we have offset of SQQQ in June is because our biggest position in our long-term portfolio is Apple. And so we protect it with the thing that protects Apple the best, which is the Qs. This is what balance is all about, but you've got to understand, again, it goes back to you have to understand your trades, you have to understand the option spreads, you have to understand why you're doing these things. It can't just be numbers on a paper. That doesn't make any sense. Here's Arrow. I love these guys at this price at 242. We have a 2.5 spread. We have a 350 short puts. And again, very, very misleading. This trade is showing a loss, but what's the reality of the spread? We sold the 350 puts for $1.72. That's a net of, what, like 180. So our net entry is $1.80. Well, that's weird. What's 185? What is that column? Current price today. Oh, I see. Just coincidentally happens to be the price of these options today. But anyway, our net entry on Arrow is 180. Arrow's at 242. That's like 60. That's 33% higher than our net entry. Yet we're being charged $18,500 negative in our portfolio for those options. All we have to do is sit here and wait, and as long as Arrow stays over, as long as Arrow stays high over 180, we're not going to lose any money. But we're currently showing an $18,500 loss. Now the 2.5 spread, you've got we paid 70 cents for this spread, so we're in at 270. Yet this thing is showing us well, we're showing a property of $1,000. Okay, but so if this thing goes to 5, we have 100 of these suckers. So we're going to make $30,000 if Arrow goes to $5. We only spent $7,000 for the spread. And if it does go to 5, we collect all this money too. So we're going to make $6 by the time it gets to that price. And that's times 160,000. So if Arrow goes to $5 by next January, then we will get $60,000. That's nice. I like that. So those are two of our big plays that we have. We have this little BHI play, which I'd like to double down on. In fact, I'm surprised we didn't double down on it. I probably meant to and didn't. CCJ uranium play, again, showing a loss. No particular reason to show a loss. We bought this spread for $3. We sold these for $2, so we were in for about $1, and it's more than $1 over our strike price, so we're fine. Here's Cliffs. It's a small trade, only 20. You know, so probably we'll probably want to actually double down on that one too. Here's DBA. We like those guys. We just do them as our inflation hedge. GTAT is probably dead money. iRobot, that's another one. I don't know why we have so little of it. I guess it got away from us before we got a chance to build it up. Lulu's always nice, and they're in good shape, of course. In fact, this one's blown above our strike, so we're not going to be able to do anything with that other than just wait to collect the money. Mattel, I think, is good for recovery. I love that stock, and I like this trade a lot, and still buyable. Here's another Silver Wheaton. I don't know why we have it in the long-term and the short-term portfolio, but we do. Taser, another one of our long-term big stocks. So Taser, to be clear, Taser is our stock of the decade. iRobot is our stock of the century. So Taser is already on a tear. In fact, it's completely blown over our targets. We had a $20 target for next January, and it's 26 already. So we may have to do something about this, like cash it out early and reposition it to a better strikes. Toyota, obviously another one, and that's where it is actually right on target, frankly. I mean, it's we played the 110, 135 for next January, and it's a 125.8, so we're in good shape. Okay. And Whole Foods, another one's completely blown through our numbers. So, you wonder why I never touch these things. What are you going to touch? They're all great. These are fantastic positions. And you know, notice they're diversified. We have food, we have cars, we have stun guns, we have silver, we have toys, we have yoga pants, we have robots, we have glass. Totally, that one failed. We have agriculture, we have metal, we have uranium, we have iron, we have some other material stock here, and coal and all that crap that they do. We have clothing, we have Apple, consumer stuff, we have rig with the drills, we have NOI, which is a REIT, we have another REIT over here, we have Approach, which is a driller, and then we have some miscellaneous over here. But you see, it's like a nice variety of stuff. We don't have any healthcare because it wasn't cheap. It hasn't been very cheap this year, so we don't have any healthcare stocks. We probably should. We have no utilities. We didn't do any plays like that. That's a shame. We missed all the utility rally. But it's a nice diversified bunch of stuff, and we understand all of them. We know how they all work. It's a very mellow portfolio, and it's supposed to be. And we're not shooting for the moon. We're trying to make 20% a year. We're trying to make $100,000 a year on $500,000 worth of cash. That's all we're trying to do. It's not a crazy goal. All right, and this year we made it. And by the way, the first year is the hardest year, so we're in great shape because we made 20% the first year. The first year is the hardest year because you're setting up all these plays. As the plays mature, then we sell more premium, but we don't have to buy any premium because we already own the stocks. All right, Christy's asking, do you ever physically put a stop in Thinkorswim or any of your naked plays? And if so, can you show how you do it? I don't put in a stop because I'm here every day, so I don't worry about it. But putting in, I don't like putting in a stop. If you put in a hard stop, the chances are, if it's anywhere close to the money, somebody's going to try to trigger it for you. All right? But putting in a stop is real easy. In Thinkorswim, all you have to do is set it up. See, if you go to like, if you have a position like an ABX, right? So here's 10 short, whatever the hell these are. The January 17, all right, so here's 10 short January $17 puts, right? And they're at 650, I guess. And these down like 30, so they're down 3,700 bucks. All you got to do is just go, you right click on it, and you create a closing order, and you say buy it, and there's a conditional thing here. Oh, see this stop limit? All right, so you set it buy, stop, and you set your stop price. It's not hard at all. All right, so you just punch in your stop price, and there's your stop. That's all there is to it. The problem is, wait, didn't do that, did it? Wait, sell to handle. Oh no, that's a roll. That's an ordering for a roll. So here's the conditional I put in where I said I want to do this roll from the ABX 2017's. I don't know what the hell that is, diagonal something. Anyway, so we're looking for $1.05 to make this roll. That hasn't come up yet, so I left it as an open order. I put in good to cancel. But there's all kinds of ways to do it. And by the way, if you need help with Thinkorswim, you just call them. They're going to talk. They can sit there and watch you on your screen and talk you through the whole process. So, call the number, ask for support. Don't do it during trading hours. Do it like after the market closes is the best time to call them, or early in the morning before people are working. That's when you want to call Thinkorswim. They got tons of technicians, and they're really great guys, but if you want to call them when they have time. If you call them like at 10 o'clock and they got 25 calls coming in at the same time, they're not going to be so happy about telling you all this nitty-gritty stuff. But if you call them in the off hours, they are sweethearts. They'll spend hours with you, like going through stuff. G-Bay says, you mentioned waiting to double down on BHI. Time permitting, could you go through the thinking of doubling down if it's well documented? It's got to be worth doubling down. Let's see what our trade is. BHI, was that it? Okay, yeah, it has to be down enough for it to be worth it. So here we have a $55 put. Are you kidding me? It's $10. Well, that's worth it. All right, so 100% is a good place to double down. We'll have to take a look at these. So now, well, the problem is DH, they're at 55, but we still like the premise. I don't think the deal's not going to go through. Halliburton's still buying them. So it'd be very, very unusual for this play to lose money. So the question is, you say to yourself, if you sell those puts for $10, you're netting in another 1,000 shares for a net of $45. So are you comfortable owning another 1,000 shares for $45? And if you are, then why not? Because let's say the Halliburton deal falls apart, right? Are they going to go to 35? Well, maybe they do, but then what's my risk? I don't think they're going to go to zero just because Halliburton backs out of the deal. Plus, don't forget there's a $3 billion breakup fee, which is as much as these guys are in like 3 years. They only earn $1 billion a year. So if they get a $3 billion breakup fee, that's going to be good for their stock too. So I don't see any real downside to these guys below like $40. And so if we're netting in for 45, all we're going to lose is $5,000, $10,000, but the upside on it is $10,000. So all you're doing is making an even money bet when you think the odds are in your favor. It's just like any other bet, the double down bet. But the thing is, are we forced to do this? Right now, it's like, you know, it is $45,000. We do have a tremendous amount of cash in the long-term portfolio. We're not very invested, but we have to think to ourselves, and we're going to review all these in the next week or so. We're going to go over these things carefully. But we'd say to ourselves, look, we have $573,000 worth of cash. So our entire portfolio is essentially in cash. We do have margin, of course, $300,000. So out of $1.2 million worth of margin, assuming you have a 2x margin. So on $1.2 million in margin, we're using up 25% of our margin, basically. So we've got a ton of buying power. We have $900,000 worth of buying power sitting on the sideline. But of that $900,000 in buying power, is BHI is putting aside money for BHI, one of the best uses for our buying power. Now, I think it is because BHI was almost my trade of the year because I think it's just incredibly mindless that Halliburton's going to buy them. All these options are going to cancel early, and you're going to make a ton of money. So I don't have any reason not to do it. All right. Now, I think they're going to hold this channel. We talked about that already also. Let's see. So, you know, when they were down here, they were down to 50-something. But when they were down here, I said, I think this is as low as it's going to go. Then they pop back up, and now they're back here. But I think this is, you know, even with Halliburton. See, the problem is with BHI, you're getting like $19 in cash, and you're getting 1.1 shares of Halliburton. So Halliburton's down to 40. All right? So Halliburton has settled down at about $40. 1.1 shares of Halliburton is $44 plus $19 in cash is $53. Is that right? No, $63. Sorry, it's $63. So BHI technically is being bought for $63 by Halliburton, and BHI is currently at $57.50. They should be here at $63. That's it. If the sale goes through, it's $63. It's very simple. And I know it's crazy because you say, well, that seems like so obvious that you should take $10 trillion and put it into this trade. And the reality is, yeah, it's just the possibility that something could go wrong. The whole market could collapse, maybe. Who knows? You don't want to really overdo it, but should you make this trade a big part of your portfolio? If you're going to, you know, look, you have to, first of all, any time you're going to put 10% into a trade, you have to be able to afford to lose 10% and move forward in your life. You can't say that wipes me out and I'm dead. But if you can afford to lose $100,000 out of a $1 million portfolio, if it won't kill you, I'd put $100,000 into it. Why not? This trade has an incredibly high probability of doubling, tripling your money. So why would I not want to do that? I wouldn't take all my money and put it into it because something could go wrong. Something could always go wrong. You know, look, if I told you that I'll play you roulette and I'll pay you double your money, and all you have to do is tell me what number it's not going to be. So you pick one number on the wheel, and if it's that number, I win, and you give me your money. And if it's not that number, I give you double. That's a fantastic bet, right? you understand the odds of it. The odds are, well, not counting zeros, but, you know, the odds are like 36 to 1. So the odds are only 1 in 36 that you're going to lose, and you're going to get paid 2 to 1 for winning. That makes no sense. It's a stupid bet. I'd be broke. If I kept making bets like that, I'd be broke. But on any single bet, even though it's incredibly unlikely, you could still lose. So you can't bet all your money. Even though it sounds fantastic, even though it's the opportunity of a lifetime, you can't bet all your money. And then you have to say to yourself, well, I can bet half my money. But then you have to say to yourself, well, okay, but it's half my money. What if I lose? It's not likely, but what if you lose? Can you recover? And that's what you have to look at these things like. You have to say to yourself, well, can I recover? What's my chance of losing? Not very high on BHI, but it could happen. Let's say it's 1 out of 5. Let's say it's 1 out of 3 to be safe. But you get paid double. You get paid a lot more than you can lose. So you have to weigh that out and you say, well, okay, I'm willing to risk a little bit more than I usually would risk on a trade like this, but you don't go crazy. Because you know what? Every year we find a trade like this. We did this with Caesars also. And at the time with Caesars, I said, in fact, I even called John Najarian on the Caesars trade. And I said, John, I don't see how you can lose. And he looked at the trade and he said, Phil, I don't see how you can lose. And we sat there and we stared at this trade for like 2 months, 3 months. That the trade was hanging out there, same kind of trade, it's an arbitration trade like this one, same kind of trade. 3 months the trade was available. Could not lose. I could not see, I could see where you could come out even or make a little bit, but there was no way to lose. Not that I could figure out. And then the split came, and they did their thing, and the stock split, and blah, 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 and all the things happened. And you know what? We all made a ton of money. Oh, but only the people who stayed in it. There was a point during the trade at which it looked terrible because, again, like the bad option pricing, like the numbers on the spreadsheet look terrible. The numbers on your broker sheets look terrible because they just mispriced everything all over the place. But they do that to force out people who don't know what they're doing, and it worked. I had people panicking all over the place. People were freaking out. Oh my God, this is going to happen. They're going to assign this. They're going to take that. They're going to do. It was all bullshit. It never happened. Even when you called the specialist or the broker, they didn't understand the trade, and they told them people the wrong things. The people who stuck with it made a ton of money. The people who got out of it lost, they lost money. You've got to really understand these things, commit to them, and again, it goes back to the same thing, though. If you bet too much, if you bet more than you can afford to lose, I mean afford to lose. Like say, oh, I lost. Okay, I got to work harder next week. I got to go earn some more money next year. If you can't afford to lose the money, you shouldn't play. But should you play a good portion of what you could afford to lose on something like this? Sure, because it's just math. It's highly unlikely you will lose your money. And not only that, but we're not talking about losing all your money. You're not going to bet this money. Like I said, what's their damages? Their damages, we're going to be assigned 1,000 shares of BHI at $45. So if BHI is at $35, what do we lose? We don't lose $35,000. We lose $10,000. What's our upside? Our upside, because it's not just that, it's a combination trade. Our upside is $30,000. So our upside is like 3 to 1. Our downside is 1, or 10,000 in this case. Now our upside is $30,000. That's a pretty good odds. And it's hard to see how you can lose. It's not that you can't lose, and you can never assume that you can't lose. There could be unforeseen things that cause you to lose. But the bottom line is it doesn't seem very likely at all that BHI is going to go below $35 a share. Hasn't been below $35 a share in years and years and years. Way down there, back in 2012, and only for a little bit, and then it bounced right back up. So would we sell more of the 55 or just move down? I don't know. I haven't decided yet. I'm just saying this is about the point at which you do want to double down. When you're down 100% on your put, that's when you might want to double down. Because now what happens if we double down? Then we're only going to be down, wait, let me figure this out. Then we'll have 2 that we sold for net 750. So, we're right now, we sold one for 5, and now it's 10. So we're down 100%. If we sell another one at 10, we'll have 2 with an average of 750 at 10, and now we're down 33%. So it's the same loss. The amount of money we lost is the same $5,000 loss. But what we're doing is changing the game, so now we have a lot more shares. So instead of having lost $5,000 on 1,000 shares, we will have lost $5,000 on 2,000 shares, and it'll be only 33% of our money instead of 100% of our money. So that's why it makes sense to do it. So, and also realize that from 33%, it's fairly realistic to say, okay, we can recover 33% pretty easily on a good bounce in our direction. Recovering 100%, that's tough. So if you have to recover 100%, you're in trouble. So that's a good time to double down or reposition or something. So would I buy more of the same? I don't know. We're going to have to look carefully at BHI. We're going to have to look at how. We're going to have to look at the news. We're going to have to see how the trade looks, so on and so forth, and figure out how comfortable it is. I'd like to wait till earnings, which is soon. So I'd like to wait till earnings, and I'll take a look here. It's not BHI's earnings that matter. It doesn't matter what BHI is. What matters is what Halliburton says. So Halliburton, on their January 20th conference call, is going to talk about the BHI acquisition. They're going to talk about the banks, the money. See, Halliburton declining on CEO warning. Mega deals to watch in 2015, though. Here's details about their acquisition. We talked about this from last week. I'm sorry. Those were the details of the transaction. But this was encouraging, actually. They were talking about the details were about how they closed the deal. But the details filled it in and let you know that, okay, they closed this deal. They're dead serious about this stuff. What the hell? That's weird. So we read that article last week. And Bloomberg's talking about mega deals to watch for 2015. Oh, well, it's a news thing, a TV thing. But that deal's probably going to go through. And if that deal goes through, as it's proposed, it's highly unlikely it's going to go through for less than $60. And if it goes through for $60, we win. That's all. It's not complicated. And there's always a deal like this. Every year there's something like this happens. You just got to keep your eyes open. And the other thing you got to do, though, is you have to have the cash to make these trades. You can't be tied up in a ton of bullshit. And again, this is what we've been demonstrating this year. We made this money in the long-term portfolio. We made 20%, staying mainly in cash all year. At no point in this year did we ever go past 50% cash committed. So we really made 40% on the 50% we were playing with. The other 50% has been sitting in the cash pile. What is it in the cash pile for, though? It's in the cash pile because we want to see opportunities like this come along. We want to bet on sure things. When Apple goes down to $80 for some idiotic reason, which I'm not saying it will, but I'm just saying if Apple plunged down to $80 and we thought it was ridiculous, we would say, boy, good thing we have some cash, because this is obvious. When ADX is down to where it is now, which is God knows what, like $10 or something, that's what we want to use our cash for. $10, yeah. So there's things that we want to do with our cash, and there's ways that we want to use this stuff. Oh, and also, well, I mean, in our case, basically, from a member's perspective, a lot of us are playing the futures, too. We make a ton of money playing the futures. That's a fun thing to do with our sideline cash. We have tons of cash, tons of margin, and we make this quick in and out money. That doesn't reflect in our portfolios, of course. That's just money we make off our cash. But we don't log those into the portfolios because not everybody plays them. But those of us who have large accounts and are sitting in lots of cash, which is basically our strategy, have plenty of money to play with the futures. And we've had some incredibly obvious trades this year, like oil going from $100 to $50 has been an incredibly obvious trade all year long. All right, and in fact, now we're long on oil. Now we've taken a huge long position in oil because oil going from $50 back to $75 is just as obvious. And next year, I'm going to index, let's say $75 is what? Up 50% on USO. So if we take a look at the long-term portfolio, we've got 50 of these guys at 20. So if they go up to 30, these things will be worth $10,000 each, and they'll be $50,000. So we'll make a profit of $25,000, let's say, on this. And so next year, we'll make $25,000. Right now, it's showing a $7,000 loss. So next year, we'll have a $25,000 profit. And you guys will be saying, well, where do we find trades like this? This is them. But you don't want to buy it when it shows a loss. You don't want to, you don't want to look at this chart on USO. And you look at this chart and you say, oh my God, it could go to 10. Because, because if you don't have a value that you can embrace and understand, then you can't trade it. But I can take $25,000 of my long-term portfolio. So we spent $25,000 and we bought 5,000 contracts of USO. Now, if USO drops to 10, I'm going to take another. Well, I don't need $25,000. I'll need half that much money, right? So I'll need $12,000 more dollars to buy another 5,000 for 10. And then if it goes to 5, which is completely insane, of course, because oil would be like $10 a barrel. But if it goes to 5, then I'm going to take another $5,000 and buy another 5,000 contracts, and I'll buy those, and then we'll have 4,000 long contracts of 20,000 long contracts of USO, and I will have spent $50,000 to be long. And you know what? I'm going to be thrilled because I'm long USO at like $10 a barrel. I'm sorry, I'm $10 a contract. I mean, so. Yeah, well, again, I don't see. Yes, there are technical signs. Obviously, that it's going. He's talking about the MACD, which is up here, or wherever the hell it is. Anyway, these kind of things. This is starting to curve up. This is curving up. This is curving up. So there's some good signs here. But the bottom line is, oil is worth more than $10 a barrel. Okay, for plastic, it's worth $10 a barrel. Just so, like, we'd start making everything out of plastic if oil was $10 a barrel. $20 a barrel, yeah. You can't get it out of the ground for $20 a barrel. You can't get it out of the ground for $40 a barrel. So there's a floor. And that floor is not being priced into the current price. It can't stay that low for that long. The cost of producing it is higher than that. Therefore, what will happen? It takes time, but eventually there'll be shortages. Because people stop making it. And if they stop making it, then the price goes up because people aren't going to stop buying it just because you stop making it. It's inelastic supply and demand. It's an inelastic demand. The supply is not inelastic. Well, the demand is inelastic. Anyway, so I don't care if this is the right place to buy oil. I think it is. I'm pretty comfortable with this spot at $55 a barrel. And so we made a pretty big commitment, which isn't, but it's not huge because, frankly, again, like I said, if it goes down to $40 a barrel, I'm happy to buy more. And if it goes down to $30 a barrel, I'm going to buy more. And if it goes to $20 a barrel, I'm going to buy more. And we're going to roll that position. And we already made a call to roll that this morning down to a lower strike. We're going to roll the position. We're going to double down on the position. We'll roll it again, and we'll double down again until we've got a shitload of oil of USO contracts at a long position. Because eventually something will happen, and oil will go back up, and we'll make a fortune. And the lower it goes, and the more we buy, the more we'll make. But that's because we know what it's worth, and it's worth more than 20 on USO, I mean, not oil. So we know it's worth more than 20. And that means when it's at 20, I want to buy it, and when it's at 10, I want to buy more, and when it's at 5, I want to buy more. It doesn't mean I run away from it. It doesn't mean I want to set stops. I'm not going to panic out of it. Because if you sell me Levi's at 30, I'll buy a pair. And if I come back next week and they're 20, I'll buy another pair. And if I come back next week at 10, I'll buy another pair. Because I'm only 50 years old. And 20 years from now, I'm going to have these brand new Levi's sitting in my closet that I never have to bother wearing because I bought 3 pairs on sale. And I'll feel good about that. So it's about knowing the value of the things you're buying and understanding what you're trading. And if you don't understand oil, don't trade it. Yeah, right. So if you don't understand it, don't trade it. Trade something you do understand. Trade McDonald's. Trade Coke. Trade supermarket. It doesn't matter what it is. Just trade something where you understand the product and the business. And that way, when it's down and it's cheap, you'll know why it's down and cheap. And if something bad does happen to it, you'll understand what's bad and happening to it, and you'll know it's time to get out. These are not random numbers on random charts. Okay, these are the value of a company. There's a worth to these things, and it's telling you a story of what people think of the value of the company, or in this case of oil. But that doesn't mean those people are right. In fact, certainly, here's the thing. This is what you really have to understand about these moving averages. The consensus of the people, the large amount of people over a large amount of time, is still 34. These 200-day moving averages, that's what matters. Over the last 200 days, the average person has bought and sold oil at $34. Not $20, $34. Now, they could have all been wrong. They could have been wrong for years. These guys could have been wrong for years. But the bottom line is, look what happened here. It went down to $34 here. Then it came back up. Now the 200-day moving average is here. I'm not talking about what this went down to, the actual price. I'm saying the 200-day moving average went to 34, just like this. See this dip? Went from here to here, just like this. Went from here to here, and then it started recovering. Held flat, came back. Meanwhile, this oil went from here to here, all the way up to here, all the way back to here, all the way back to here, and now for some crazy reason it's here. But, you know, if you look at like a monthly chart of oil, it's a spike down. That's all it is. It can be reversed very, very quickly. I think fundamentally oil is going to stay at a fairly lower range if you look at the actual oil. There you go. Oh, no, intraday, okay. If you look at actual oil, I think that the new range, this is probably close to the correct, that 70 is the new reality for oil, because it never should have been this high in the first place. This was all ridiculous, and I said so the whole time it was up here. But somewhere in the $70 range, and $70 range means it can easily go up and down 20% from there. So 14 down is 56, where we are now, and 14 up is 84. So somewhere between 50, right here, 85 and 55, that's probably the correct range for oil. And that's those are your Levi's. When they're 55, we want to buy them. When they're at 85, we want to sell them. Very, very simple. That's our plan for the next 2 years. So right now they're at 55 and we're buying. And if they go to 35, that doesn't mean I feel like I'm wrong. It means I want to buy more. So I'm like 55, I love. 35, I totally love. You know, let's say, I forget Levi's. Let's say it was a car. Like, let's say it was a Toyota. Let's say you have a, let's say you have a Range Rover, right? $50,000 Range Rover, or whatever they cost, 60, whatever they cost. So let's say it's a $50,000 Range Rover. So you like your Range Rover. You got one. You're happy. You go to the store, you pass by, and then you see one in the window. You see a brand new one, $50,000. You're like, so what? I got one. I'm fine. It's only 2 years old. Then you drive around and you see one for like $40,000. Now you're getting tempted because you're like, wow, $40,000 for a brand new one. I can get rid of this one probably for $40,000 and get another one for $40,000. It seems pretty good. Then you go. Now you drive a week later and you see it for $30,000, right? Now, what do? Do you not want to buy the Range Rover? Do you say, oh, no, it went from 40 to 30. It's probably going to be 20. I don't want it. In fact, I better get rid of mine. So it doesn't work that way, right? You're driving your car. You're happy with your car. You don't care what they're priced at now. But if they start throwing some ridiculous sale at $20,000, you say, you know what, I'll buy one. And if it goes to $10,000 a week later, when you come to pick up your car and it's 20, and now they're selling another one for 10, another Range Rover for $10,000, brand new. Are you going to say, I'm not going to buy one because it's $10,000? You're going to buy another one. And you come back a week later to pick that one up and it's $5,000. Are you going to not buy another one? Are you going to say, I don't like Range Rovers anymore? You're like, no, it's a $50,000 car being sold for $5,000. Even if you think the new value is $25,000, it's still $5,000. I'm sure my brother would want one. I'm sure my mom would like one. I'm sure my uncle would like one. I'll buy one for everyone in my freaking family for $5,000. But that's because I understand the price and the value of what I'm buying. And when it goes on sale, I buy it. I take my cash off the sidelines and I do it. And that's how you got to be about stocks too. The fact that the price of oil has plunged to 55 is caused by an oversupply and a dropping demand. But eventually they'll find an equilibrium at a lower price range than where it was. It'll never go back to 105. Well, it could for weird reasons, but it's not likely to go back to 105. But it sure as hell isn't likely to stay at 55 either. All right, I got to call this thing a day. Let's see. Last couple of things. Koch brothers are plutocrat a-holes. Well, we know that. But no, it doesn't help you because unfortunately what they are is they manipulate billionaires who manipulate their own stocks, so I'd stay way away from there. That's the thing. Like, it's, again, that's like Elon Musk, right? Because Elon Musk manipulates the price of his stock by putting out tweets and making comments and putting out fake Hyperloop BS things. In fact, I see these Hyperloop things. Again, there are articles that come around the Hyperloop. I mean, okay, the Hyperloop doesn't work because you have to spend 45 minutes in a sealed tube that has no way to get up and go to the bathroom. How many people are really going to go on that? Do you want to be on that thing with a screaming baby for 45 minutes? You can't get out of the seat. There's no room. You can't even stand up, actually. So you're laying there 45 minutes without moving. Try doing that on your couch and see if you want to take that trip. Okay? So it's not going to be for everybody. It won't be, old people aren't going to like it. People with babies can't do it. Families can't do it. There's all kinds of problems with it. It's a fantastic idea, assuming even the physics works. I'm saying realistically, just because the physics work doesn't mean people are going to put themselves through that hassle. Yet a ton of articles have been out the last week, again, because Elon Musk has a huge public relations firm that pumps out this bullshit to get his stock price up when he needs it. And that's what he's doing right now until the end of the year. And the Koch brothers are just like that. If you watch CNBC, you see a Koch commercial like every 15 minutes, or on Bloomberg too, the Koch commercials. I know, you know, it's the same damn commercial over and over again, unfortunately, but these guys have people who promote them. They have PR experts. They have paid reporters. They own magazines that publish stuff for themselves. You got to be very careful trading when you come head to head against these kind of people. All right. Anyway, skydiving and gun range automatic firing this time. Not sure what that means. Did I miss something? I must have missed something on that. GWAR. I don't know about that. He said, please disregard. Okay, that makes more sense. Okay, because I have no idea what you're talking about. All right, and Jeff says that's table pounding. Yes. No, I'm not telling you to be scared shitless. I'm telling you guys, I mean, I'm just trying to get the concept of value investing across to people. I want people to start embracing what you know and understand and build off of that. Don't rely on other people to understand things for you. You guys are all intelligent, professional people who've come a certain distance in your lives and accomplished certain things. And you want to draw on that knowledge and use that as a base that you're going to build your investing foundations on. Do it off that. You'll be so much happier if you start trading the stuff you actually know and understand. And you don't and don't wait for me to make a trade. If you want to ask a question, this is what I'm here for. It's like, say, I want to trade this stock. I like it because of this. I'll take a look at it from other perspectives and talk to you about what I think about it and so on and so forth as a company, as a stock, as a trading vehicle, so on and so forth. But the idea is that you guys know stuff. You know people. You understand companies. You have relatives and friends and so on and so forth who have different businesses. You know who's doing well. You know where they're building a new factory. You know where they're putting up new stores. You know that they opened a Lululemon in your mall and it's doing fantastically. You know, you have actual experience that you could base your investments off of. Don't rely on other people to tell you what to invest in. That's all I'm saying. This stuff is not complicated. Just start off with stuff you know and build a good foundation. And that's what we're going to show you how to do this year. We're going to get into, like, most of the theme of this year is long-term investing. Last year the theme was be the house. Hopefully we've gotten that point across that you're going to sell premium, not buy it. And next year we got to talk about the benefits of these long-term accumulations of capital. Don't gamble in the market. Don't try to get these crazy gains. Don't play momentum stocks. Just build a solid foundation and let it grow over time. That's what I want to get across. All right? So more on that next week then. Have a happy New Year, everybody. Thank you very much for coming.